Hi, everybody, and welcome to the Equity Instrument Features Question Crunch. I'm very excited about this because it's the first Question Crunch format video that I'm recording for the channel, so I hope you like it. But by the time you watch this one, maybe this will already be a long-established feature of the channel. So the idea is we're going to solve some questions that cover the topics that were the problems and topics that were discussed in the last couple of videos. I believe it's the first two videos for Learning Module 1 under the Equities section. So here they are. Hopefully we're going to tackle these problems from different angles. I mean, it's relatively easy stuff. So if you know anything about equities and common shares or preferred shares, you should find this easy. These will be purely theoretical questions anyway. So let's get started. The first question reads: an equity investor holds shares in a company that pays no dividends and undergoes no restructuring. What is the sole source of the investor's return? Now, before we answer the question, let's just understand why this was also mentioned here, this idea of no restructuring. You see, when a company goes through a restructuring, there is the possibility that there will be some kind of distribution of funds to investors. The company may shed, may become smaller, may morph into something different, with payments going out to shareholders potentially. But here the idea is no dividends and no other source of payment to shareholders. So what is the source of the investor's return? And if you scan the answers, you should very quickly pick out that the correct answer is A, price appreciation or depreciation of the shares indeed. So up or down movements of the shares. And you may think, well, this is easy. This is below CFA Level 1. It's actually discussed in the first learning module of your equities section of the curriculum. So it's a fair enough question. Of course, why are the other answers wrong? Periodic coupon payments from the company, that's only going to be relevant to debt securities which pay coupons or interest, and contractual repayment of the original capital investment. There is nothing, and I've pointed this out in the previous videos, I think strongly enough, there is no contractual obligation for the company to repay anything to investors. So the original capital investment will not be returned to investors as such. No obligation exists. Obviously, a company may do so, but it's not part of an obligation. The next one: which of the following most accurately describes a dividend? Once again, hopefully this is going to be quite easy. Let's scan the answers. Answer A, a contractual periodic payment that must be paid when net income is positive. This is absolutely wrong. You should be able to point that out. First of all, there is, a dividend is not contractual. That's something I've hammered in through the videos, hopefully. Therefore, it's never the case that it must be made. And definitely, it doesn't have to be made when net income is positive. When income is positive, net income is positive. It doesn't mean that a dividend will be paid. A company might just as well decide to reinvest that dividend or plow that income back into the business via retained earnings. A fixed cash payment, answer B, guaranteed to shareholders at the end of the financial year. Once again, not really fixed, unless it's a preferred dividend. But still, it's not guaranteed. A dividend is never guaranteed. So it has to be answer C. Let's see if it's correct. A discretionary, yes. So at the discretion of the company, nothing obligatory about it. Net income distribution to shareholders, which a firm may pay regularly, occasionally, or not at all. And that's taken straight out of the curriculum, this regularly, occasionally, or not at all. And I also featured it in the previous videos where we discussed the topic. Okay, next one. A company is in the startup phase of its life cycle. What type of return do equity investors most typically seek? Now, you should remember from the videos, or just simply know that in the startup phase of a company's life cycle, typically, businesses enjoy very little revenue. Typically, they incur losses and negative cash flow because you're constantly putting more money into the business just to keep it going, or whatever is generated gets plowed back into the business. So it's not really the time to pay dividends. So which type of return do investors most typically seek? A regular dividend income because startups need to attract income-seeking investors. That's absolutely not true. You're not going to be expecting a regular dividend because there is no kind of money for it, to be honest. And by the same token, answer C, which says both capital appreciation, i.e. increase in value, and regular dividends in equal measure, that's also wrong because you're not going to be expecting regular dividends, but you should be expecting the startup to grow over the long term. Capital appreciation rather than current income. That's the correct one. Next one. Number 4, what is the key difference between the dividend policies of mature companies and startup or growth companies? Right, we just discussed startup. Growth is the next phase when the company is already starting to generate sort of profit and cash flow in terms of positive profit and cash flow. Whereas mature companies, you would expect them to be plowing, churning sales and generating profits and positive net cash flow. So mature companies with, this is answer A, with stable cash flows. Yes, that's the general idea. Stable, mature companies should have stable cash flows, are more likely to distribute earnings, i.e. as dividends. That's absolutely true. Whereas startups and growth companies typically retain all earnings for reinvestment if they have earnings at all. That's absolutely true. This is, this kind of gets the facts right. So answer A is going to be the correct one. Let's just inspect very quickly answers B and C. Mature companies pay no dividends because their reinvestment needs are the highest. Not really. Their reinvestment needs, obviously, in comparison, in relation to their size, are not going to be necessarily very high. It's typically the replacement sort of capital expenditures, replacing used property, plant, and equipment that goes on at mature companies. Startup companies must pay dividends to attract initial equity investors. Mature companies are not required to pay such dividends. Well, this is kind of repeating the same point as before. In what was an incorrect answer, startup companies do not attract initial equity investors via dividends. They do so via the prospect for capital appreciation. Okay, next one. What document is distributed to prospective investors coinciding with a share issuance outlining key features of the equity security and use of proceeds? Now, I believe this is not one that I kind of explicitly mentioned in the video, but it's in the last kind of 2 videos in this learning module, but it's something we will be discussing later on when we get to IPOs, initial public offerings, and equity issuance in general. So now look, you may know this, you may not know this, have a go by all means, but it is going to be the equity prospectus. That's the formal, this is what we formally call the document, which is distributed to investors taking part in a public offering of shares. Although, as we will be discussing later on in the curriculum, in our exploration of the equities curriculum, an offer of shares may happen via a private placement. This is where, instead of addressing the public at large, you are addressing the issue to a defined, closed group of investors, and then the requirements in terms of providing them or with very sort of thick, big documents are not as high as those associated with a public offering. In such a case, we would be talking of what's known as an equity offering, memorandum. This is the correct answer. Now, what some of you may find confusing if you know a little bit about this is answer A, and I'm glad if you find it confusing because that's the whole point of solving such questions, because as part of an equity prospectus or indeed an offering memorandum, so the correct answer, you would still find the annual report. The annual report is part of the prospectus. The company's sort of financials are part of either this or this. So why is answer A wrong? And this kind of is all about reading the answer carefully, the potential answers carefully, and not jumping to conclusions too quickly. You see, the annual report summarizes performance after the shares have been issued. No, an annual report provides a summary of financial performance, well, up to date, right, until the share issuance, not after. So this is what's wrong with answer A. Otherwise, it would be kind of partially correct. Annual report, yes, it's part of the equity prospectus, but it doesn't, it's not an ex ante document that forecasts performance, but summarizes what happened thus far. And answer C, the articles of incorporation, so the legal basis for the company's sort of formation, it's absolutely relevant. But once again, it's not about defining the company's governance structure. If you look carefully at answer C, at the point of its formation, which may have been many years ago, what you are really interested in is the governance structure, for example, the relationship between the board of directors, the founders, and the new shareholders, etc., from now on, as opposed to in the past. The past is not really that relevant. Okay, so that was answer B for sure. Now, question 6, which of the following correctly describes the claim of common shareholders upon company liquidation? Right, common shareholders, of course, are one group of capital providers. We also have preferred shareholders and the providers of debt. And there is a strict hierarchy in terms of what happens upon a liquidation, which you should already know. Common shareholders definitely do not enjoy a priority claim. Priority claim, they are repaid before debt holders as the primary risk takers. Yes, they are the primary risk takers, but they are the primary risk takers partly because they are at the very end of any hierarchy. So they share in what's known as the residual interest, or they get the residual interest in the net assets of the business. They don't have an equal claim alongside preference shareholders. Preference shareholders rank higher, so they don't share in the net assets of the business proportionally with preference shareholders. They do indeed, so that's wrong. They do indeed come at the very end. They get the residual claim. They receive any remaining assets after all debts and preferred shareholders have been paid. That's generally the idea. Now, number 7. A company has missed its preference dividend for 3 years. However, those preference shares are cumulative. What must happen before common shareholders can receive any dividend? This is an important point regarding whether you know what so-called cumulative preference shares do. And hope you still remember. The idea behind cumulative preference shares is that any preference dividend that was not paid in the past must first be caught up, so that it must be paid before the company can start paying any ordinary dividends. So in this case, if there have been 3 years of no preference dividend payments, then all 3 years must first be paid, or 3 years worth of dividend in full, before common shareholders can receive an ordinary dividend. The remaining answers are completely wrong. It's not only the most recent year's missed dividend must be settled. No payment is required. Cumulative arrears, so the past missed payments, they extinguish after 2 years. That's also not true. Obviously, in reality, a lot depends on what's actually written in the terms of the the prospectus or the offering memorandum for the shares. There may be special clauses which void the cumulative feature in some way, or cancel it. But to be generally speaking, for the purposes of the level 1 exam, you just take for granted that those missed preference dividends have to be paid first, providing we are talking about cumulative preference shares. If they are non-cumulative, then no payment would be required because they don't accumulate. Number 8, what right do puttable preference shareholders hold that standard preference shareholders do not? Now, the idea behind puttable instruments is going to be universal across equities and fixed income or debt. The same goes for callable instruments. A put option allows the owners, the shareholders in this case, to put the securities back to the issuer, namely force the issuer to buy them back for a price which is typically known in advance. It's determined in accordance with a schedule or just written down. So this is not about the right to convert into a specified number of common shares. That would be convertible preference shares. It's not about the right to receive an additional dividend when the company's profits exceed a threshold. That would be participating preference shares. But it is very much about the right to sell their shares back. So kind of force the issuer to take those shares back in exchange for a predetermined price. That's the whole idea of puttable instruments, in this case, puttable preference shares. Right, just a few more to go. Which contingency provision gives the issuer, not the investor, right? You have to be very careful about who you are thinking about here, not the investor, an option over the preference shares. Callable, puttable, or participating preference shares. Right. So let's read this. Callable preference shares. The issuer has the right but not the obligation to repurchase at a predetermined price. This is the correct description of what callable preference shares are. They give, or the call option, the call feature, gives now the issuer to call those shares back, as opposed to the investor putting the shares to the issuer. It's a right, but it's a right granted to the it's a right granted to the issuer. So this is absolutely correct. It's a feature that favors the issuer. It gives the issuer, not the investor, an option over the preference shares. So this is pretty much solved now. It's done. It's callable preference shares. But let's just have a look at the remaining two. Puttable preference shares. That's where the investor has the right to get the issuer to redeem the shares. The investor may force the issuer to redeem at a set price. Well, it's once again the correct answer here. This is as a description of what puttable shares are. This itself is correct, but the answer is incorrect because it's an option held by the investor, not the issuer. And what about the final one? Participating preference shares. The issuer decides whether to pay the additional dividend. Well, participating preference shares do give, this time, the investor an option. Well, it's not an option, it's really the right to receive an additional dividend if the performance of the company underlying business, the issuer, exceeds a certain target. But it's not the issuer who decides whether to pay, whether to pay this extra dividend. If it was up to them, it wouldn't necessarily be a true participating preference share. So this is wrong, and in any case, it gives the investor extra rights. So this is the wrong answer. Okay, four more to go. Sorry. An investor seeks equity securities with the possibility of receiving additional income if the company's profits exceed a specified level alongside a fixed minimum dividend, so a kind of floor. Which type of preference share meets both objectives? And I think from what I've just said a moment ago about participating preference shares, you will be able to spot the correct answer. It is participating preference shares. They are the ones that give the shareholder, the investor, the right to receive an extra dividend if a certain earnings target is met. It's not cumulative preference shares. It's not puttable preference shares. The cumulative feature and puttability feature are nothing to do with the size of the dividends. It's more about whether missed dividends will be accumulating and accruing, and puttability is all about being able to force the issuer to take those shares back for a fixed price. 11. Comparing common shares, preference shares, and debt. Which combination of features is shared by both common shares and preference shares, but not by debt? So this is going back to an important point, I believe, from the first video concerning the very was it the first or the second video? I can't remember now. The very sort of hybrid nature of preference shares, that they share preference shares or preferred stock shares features of both common equity and debt. Right, voting rights and residual economic claim. Well, we're looking for features that are not exhibited by, not characteristic for of debt, but shared by both common shares and preference shares. And you know that preference shares typically do not have voting rights, or at least you should know this, so that's wrong. What about B? No contractual obligation to make periodic distributions. That's true. There is no contractual obligation within common shares and preference shares for the issuer to pay you a dividend. So that's correct. But there is, with debt, the obligation to pay periodic distributions like coupons or interest. And indefinite life, no fixed maturity. Yes, that's generally true. Most shares, be they typically all shares, common or preference shares, do not have a finite life. They have an indefinite life, so no fixed maturity, whereas debt typically has a fixed maturity most of the time, although not always. And so that's going to be correct, but on both counts here. So that's going to be the correct answer. We can identify it as such. What about the final one? Senior economic rights and finite maturity. Of course, finite maturity is completely wrong. That's not true of shares. And senior economic rights is not true. It's actually debt. This would be a description of the position of debt holders rather than shareholders. Okay, number 12. A preference shareholder holds shares in a company that is liquidated. Okay. After all debt is repaid, the remaining assets are worth exactly the liquidation preference payout amount. What do common shareholders receive? So, the liquidation preference payout amount is the amount that the preferred shareholders are should be receiving. And remember, they come first. So, or before any common shareholders. So if the amount left after the repayment of debt is just equal to that much, enough to pay the preference shareholders, then the common shareholders will receive, answer A, nothing, because that liquidation preference absorbs the remaining assets in full before any distribution to common shareholders can be made. This is wrong. We don't share pro rata evenly the amount that any money left, any net assets left among the common shareholders and preference shareholders. And it's not that this residual amount is going to be paid to the common shareholders in full, because preference shareholders have already been considered because they are senior to debt holders. No. So what this is getting at, answer C, is that perhaps because you've already paid the debt holders, that implies you've already also distributed money among the preferred shareholders because they are in some way senior to debt. They're not. They are junior to debt, but senior to common shareholders. Anyway, answer A, sorry, was the correct one. And to finish things off, we've got question 13. Now, this is getting at a theme which I see being kind of pushed in the curriculum quite a lot in that first section on equities. So I decided to include this question or create a question on it. An investor holds convertible preference shares in an early stage company approaching its IPO. What two benefits did the company gain by issuing convertible preference shares? Okay, the point is, startups, early stage businesses, if they want to attract capital, they often, or at least sometimes, do so by issuing preference shares. They could be convertible preference shares. Sorry, they could be participating preference shares, but convertible is quite common. What that means is that at some point, those holders of the convertible preference shares will be able to convert into ordinary shares. And by doing so, that ability to convert into ordinary shares of the business gives them the upside potential associated with increases in company value. If they see that the company has grown and it is still growing, then they may wish to become ordinary shareholders. But for the time being, they're kind of sitting safe with their preferred shares, which are senior to ordinary shares. So, what benefits did the company gain by issuing such instruments? The first answer A is kind of wrong because it talks about higher voting rights for founders. Well, if the founders are holding ordinary shares, they will have voting rights and guaranteed conversion at a premium to the IPO price. There is no guaranteed conversion with convertible preference shares. That doesn't happen. It's always an option, a right which the investors hold. What about answer B? So that's wrong. A lower dividend cost than standard preferred shares and the ability to retain ownership control prior to the IPO. This is actually the true answer, and it's a bit tricky, so let's discuss this. Why do the convertible preference shares associate with a lower dividend cost than standard preferred shares? Well, it comes from the sort of trade-off argument. If you give preferred shareholders or any investors kind of something extra on top of what the plain vanilla standard product is. In this case, if you give them preference shares, but with the convertibility option, that makes the instrument better, more valuable than just a plain vanilla one, a standard one. And you can convince, therefore, these investors to take up these shares and perhaps, and probably actually, accept a lower dividend. So, a preference share without the convertibility option would typically have a higher dividend, fixed dividend associated with it. One that has the convertibility option may be sold with a lower sort of promised or fixed, expected fixed dividend. And so this is absolutely true. You economize on that, and at the same time, you, as the founders, as the original sort of owners of the business, you retain ownership control prior to the IPO in the sense that preference shares, including convertible preference shares, do not carry voting rights. So the existing owners are more or less free to do what they want. They retain operational control. And additional capital has been sourced via preferred shares at a lower cost than would be the case if it was just pure preferred shares. These are convertible, so the cost is lower. The promised dividend is lower. And the final point, so that's the correct answer, but the final answer here, C, access to debt financing and exemption from preparing an equity prospectus. Well, that's not true. You can get access to debt financing pretty much at any time, although early stage companies don't generally go for debt because not many people will be willing to provide debt unless it's kind of on special terms. Convertibility options included, and exemption from preparing an equity prospectus. That's not true. I mean, you always have to, when you start selling, be it ordinary or preferred shares, you have to prepare a prospectus or at least an offering memorandum, and that will depend. Which one of those is true will depend on whether the offer is a public one or a private one.